Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Pete, mate, welcome back on the show. It's great to have you.
Pleasure. Great to be back.
For those who don't know, this podcast series featured Pete Wargent in the first season, and we did a long discussion a bit about your history, some of the books that you've written. We'll get to another one that you've penned recently. But if anyone wants any context on who Pete is and how he came to be where he is, please go back and listen to that episode. Another note that Pete and I will make is that this video, this recording is actually going out in video format as well, which is a great thing because you get to see us talk. But if we also include slides or charts or refer to any data, we'll hope to present that to you either in video format or in the show notes. That said, Pete, why don't you just give us a quick 101 Pete Wargent, tell us about yourself, tell us what you do today, and just catch us up to speed on everything that we've missed over the past year.
Yeah, cool. I think on that note, Owen, I might just, for the people who are watching on video, I'll bring up a slide or two. So yeah, that's me, petewargent.com if you're very bored and you want to read a bit more about my bio. But yeah, I guess as you can hear, I'm British Australian, born in the UK, been in Australia since the 1990s. Predominantly known for real estate commentary and our real estate business, but we do some coaching programs as well. And yeah, I guess I have done media a lot over the years. I was disappointed last year when I went on Sky News Business to be referred to as, I think it was a veteran of the industry. It was only about 3 years ago. I was a promising youngster. So that's, yeah, life comes at you fast.
Doesn't it indeed? Yeah, you talked about this in one of your books, Get a Financial Grip, where you talked about all of the strategies that you use, and it wasn't just property, right? Like you're investing in index funds and a whole range of different products, right?
Yeah. So I think, my first book, I wrote it in 2011. So I think in terms of the environment, the landscape, I mean, we had falling interest rates, and also if you just looked at where globally stock markets were sitting, there was a decent runway from there because we were only just really recovering from the financial crisis, and then the euro crisis put a lot of valuations back down for a while. So I guess there was it was a pretty easy time, in terms of from a passive investment perspective, you could pretty much hoist the sail and let the markets carry you along. But I guess as we'll come on to, the most recent book we wrote back end of last year, obviously a very different environment with a CAPE ratio of 33 and the expected returns obviously much lower.
Yeah, you mentioned the book back end of last year of 2019. We chatted just quickly off air before this about how you met Stephen. Perhaps you can recount that encounter for us.
Yeah, so I've co-authored, the new book is called Low Rates, High Returns, and it was really written to tackle this global challenge, really, of low interest rates. And from a timing point of view, the book's due to hit the stores in the next week or two. And cool. I guess interest rates, as we thought they might, have effectively hit the zero lower bound in Australia, but not just here, all over the world. We're seeing unconventional measures. So that was why we wrote the book. The guy that I co-authored the book, Stephen Moriarty, I actually first came across for my sins on social media on Twitter. He used to chirp me about various bits and pieces, and I was on the verge of blocking him at one stage. But he being a Brisbane chap, he used to go to the local coffee shop in New Farm where I was living 4 or 5 years ago, and just became a daily routine, really, going to the coffee shop and talking shop, talking markets, and I guess over a period of 4 or 5 years, our ideas grew from there.
Yeah, it's funny how the the Twitterverse can connect so many of us, and particularly in the finance community.
Man, it's a double-edged sword, hey.
Yeah, it is indeed. Yeah, it is indeed. Like you said, a lot of us quite a few of us are actually pretty active on the blocking side of things. But I guess the thing is, it is a really good way to connect. And like you said, you're on there daily. I'm on there probably almost daily, at least trolling or looking at what everyone else is writing. But it's a great way to connect. And I guess this chance encounter for you has led to a book, which is a great thing. And for those who want to know more about it, you've got a free chapter available online. So I'm hoping to grab a copy as soon as it comes out. But yeah, so we'll have some things in the show notes. With regards to, I guess without giving away all of your secrets that come from the book, what are some of the big picture takeaways, or just one or two of the big picture takeaways that you have? Because for me, investing in such a low interest rate environment, I kind of think like we've so many big pension funds, so many fund managers and multi-asset managers are moving further down the risk spectrum. And even individual investors, like we say this all the time, what would have been maybe, a diversified bond fund has now become a diversified multi-asset fund where there's some risk assets in there too to get that income from dividends. It's something that I think about a lot insofar as building portfolios out for anyone. So I guess if you could distill any of the big picture items for us, what would be something that you give to us?
Yeah, well, I guess to go all the way up to the 30,000 foot view, what we start with is why you should consider managing your own money. Because as you mentioned, these days there's a product for almost anything. And therefore, given that these days you can very easily take a passive approach that just owns the whole, the whole universe of what's out there, why should you consider managing your own money? We've got a model called the 3 C's. So that's cost, choice, and control. And I think it, to a certain extent, it relates to the stage of life that you're in and so on. But obviously, if you have the control of your own investments, you can manage your exposure through the cycles. But I suppose in terms of what the book covers, I mean, even though we've written it for the low interest rate environment, we very much wanted it to be a timeless book. So it's based upon 8 timeless principles that you can apply in any market at any time. And to a certain extent, I mean, the principles apply to any asset class, whether it's real estate or equities or you name it, vintage cars. So the principles are where we start the book. So there are 4 thought principles, which are what you need to actually think about before you make an investment. So I think like a lot of people, when I started out, I used to pick my favorite company, make an investment, and then I'd go and do the research afterwards, as a form of confirmation bias. So there are really 4 thought principles that we encourage people to think through even before you make an investment. And then there are 4 action principles that you should follow when you're going through the process of making an investment. So, and as I said, these principles, they don't relate just to Australia or just to 2020. The idea is that they apply to any market at any stage in the cycle.
Yeah, right. I can see here just on the screen, you've got as 4 of the action principles: asset allocation, buy low, sell high, diversification, and rebalancing. I guess one of the things for me is that when we look across at property now, and I'm going to switch gears here a bit, Pete. When we look at property here now, if we can dive into kind of some of we go maybe from 30,000 foot down to 20,000 foot and just look over property. Considering what we've seen so far, maybe on the back end of 2019 with some pretty good results across the country, and then coming into what we've seen so far in 2020, which is kind of shock and awe. What are you seeing with regards to, just, I guess, the high level picture from an owner's or investor's perspective, and then maybe from renters as well? I know you've got a couple of blog posts out recently, that touch on these and talk about inbound tourism, outbound, people leaving Australia, and kind of the consequences of that. So, I mean, there's a lot to unpack there, but maybe we can just start with investors and what you've seen in the data so far.
Yeah, it's an interesting one, because if you go back to the 2019, we went through quite a period of turmoil even back then. We had the Royal Commission, into banking and financial services misconduct, which obviously sent a few shockwaves through, the whole sector, really. And then we had, which seems like a distant memory now, but we had the election campaign where the opposition party was campaigning on a whole raft of taxation changes, some of which would have related to investment property, and that really it stalled the housing market all the way through March, April, early May 2019. Then the election result went differently to as expected. We had very low interest rates, and there was a kind of a mini boom in property, sort of 15% gains between then and the early part of 2020. And as this year started, markets were running pretty hot. And then, of course, as you mentioned, we basically hit this sudden stop. So I've thrown up a chart for people on YouTube there to show what's happened to arrivals from China, for example. I mean, that's just one metric, but it's a bit like Nassim Taleb's old chart about the life of a Thanksgiving turkey. We were absolutely humming along, and then suddenly we hit a sudden stop. So in terms of housing, in the first instance, I think the main impact has been on the rental markets more so than on prices. Partly because, well, for one thing, the international students didn't return to Australia, but also, short-term arrivals from tourism and even just net overseas migration in general has effectively been halted. So you get into a situation where you've got all of these short-term lets, Airbnb, people who are letting to international students, and they're suddenly having to scramble to find tenants. So the first sort of shock to the housing market has really been seen in terms of landlords and tenants scrambling for deals because there's an overhang of rental property, and you can see that in the listings numbers. In quite a lot of areas, listings are up 5 or 10%. So that will have a knock-on impact to rent. There are some compensating factors in the other direction, because if you think through the resources boom, Australia became essentially one of the wealthiest countries in the world. And from about 2007, there were many more Australians actually heading overseas on a short-term basis than people coming here. So that's not happening on the flip side. And these things have a way of finding an equilibrium over time. But I would say the main thing in 2020 so far is that the rental market is going to cop a big hit.
I've noticed that so far. So full disclosure, I'm actually looking to buy a property in 2020. And currently we rent an apartment towards the city of Melbourne CBD. And, we've had scheduled inspections that have been cancelled because no one's wanted to come and have a look. I mean, that could be an inspections, a social distancing thing. It could be demand. I think personally it's a lot to do with demand. And obviously you have supply of apartments in and around CBDs, but that's my personal anecdote and experience so far in 2020.
In fact, Cameron Cusher at REA Group, who was previously at CoreLogic, he puts out some really good leading indicators on this stuff. And what he's shown is that the rental markets were really, they were very busy in 2019 and early 2020. Then we saw an enormous drop in people searching for properties to rent. I think partly, as you said, partly due to logistics, but also what you tend to see in a period of economic shock is fewer households being formed, whether as tenants or buyers, people moving back with parents and so on. And there was a big, really big drop. I think we were down 30% year on year in terms of searches for rentals. Now, I do know in Britain, groups like Home Track and Zoopla, they do tend to be bullish, let's face it, but they are saying, and they're probably a month further on in this journey, that the rental demand is now bouncing. It's not back to where it was, but it's picking up. But let's face it, if you've got a generic apartment in a new high-rise block, there's a lot of competition between landlords for a diminished pool of tenants. So you'll see a drop in rents for sure.
Do you think, obviously this is a consideration, but with rates so low, you get to that point where, I don't know if it's parity or equilibrium, what you call it, where renting is no longer the economical, like it's the best solution for you because you can swap, rental payments for cheaper mortgage repayments in many instances. So are you seeing that kind of that I guess supply and demand, the imbalance and type of thing play out in property anywhere?
Well, yeah. I mean, that's really been a factor for a few years to a certain extent. The main hurdle for buyers is often the deposit rather than the serviceability. I mean, the Q1 figures aren't out yet in terms of interest costs, but what you'll probably see is that interest serviceability is about back to where it was about 35 years ago. Not because housing prices are low, but simply because mortgage rates have just dropped to the lowest level we've ever seen, essentially. So, particularly a lot of the fixed rates now, new borrowers are borrowing at like 2.29 and, rates around that kind of a level. So, yes, you do have to repay principal at some point, especially on a owner-occupied dwelling. But you're right, the holding costs from an interest perspective, and we could have, as owners, we could have only dreamed of this back in 2006-07 when mortgage rates were pushing 8-9%. So that side of things, when Australia does come out the other side, I guess there are probably three things that are sort of supporting for property prices. One is record low mortgage rates, probably the lower Aussie dollar as well, but just the government stimulus and the amount of government involvement in the economy will need to create jobs, so infrastructure projects and so on. So when we do come out the other side, however long that takes, there are some sort of tailwinds. But the question is, well, how long does it take to get from here across to there?
We've talked a bit about residential property renters. I don't know if you have a slide on this or if you have some thoughts on this, but with the introduction of rental caps and the government effectively asking landlords to meet tenants, not in the middle, but somewhere in between. Have you seen anything play out, or have you heard from clients, or have you got any data points on that?
Yeah, it's mainly anecdotal at the moment. I think the data tends to lag a lot. It's mainly most of the people I've spoken to. It's mainly just been simply a relief to get a lease signed for 6 or 12 months, even if it's at a slightly lower price. Most landlords are happy with that. Tenants like the security, but it hasn't flowed through to the official figures yet. But I suspect what you'll see, when all the figures roll through over the next year, I suspect the median rental price will be lower than it has been. So so I mean, these things are often portrayed as bad, but it's not bad if you're on the side of the renter. So I guess equal and opposite reactions. So and that in itself can free up more capital for people to spend elsewhere.
Yeah, absolutely. I guess it's a bit of give and take there. How about when it comes to and I'm just firing off some questions here for you. It's kind of like a quick take on everything, but there's so much to get through. How about when it comes to investors and owner occupiers from their perspective? What are we seeing now?
Yeah, I mean, I guess let's do two things. One, let's look at what the stats show, and then I'll give you my opinion. So,
okay,
if you went back to Q1, Domain was very, very bullish on everything. House prices effectively at record highs. Unit prices in some areas have dropped off, but really, if you're looking year on year, they're still reporting double-digit gains. CoreLogic was the final day of the month today. CoreLogic hasn't really seen much in the way of an impact to date on prices. And in fact, the other leading indicator you look at is asking prices, which for houses, are especially in Sydney and Melbourne, are at record highs. So vendors' expectations haven't really come to the party much yet. Asking prices for units are down. But this is just my view, and this is no disrespect to anyone that compiles the data. I think we will see, when the figures actually eventually flow through, you will see that prices are down. I've seen firsthand, especially at the top end of the market, people aren't really selling at the moment because it's a good market to sell into. So I think there's much less competition at the top end, and prices above the 2 million quartile have really, there's been some discounting there. But also, you see, there's a lot of off-market transactions happening at the moment, and what you find is the prices often aren't disclosed on those, and so I think that there might be some murkiness in these figures. And when you look back in 6 or 12 months, you'll probably find that median prices have dropped. Now, I'm still seeing some instances of people paying big dollars in Sydney and Melbourne, and 3% yields on property and stuff. So it's not across the board, but I think on a median price level, you've probably seen there's just less competition and prices have come down a bit.
Yeah, I've spoken to a few agents in and around Melbourne, and they've said, it was a great January, February period, and then we got the start of March wasn't too bad, but towards the back end of March and now into April, some agents have reported a fall off in buys to the tune of 70%. So
yeah, and that's exactly what happened in Britain as well, and they're probably a month ahead. There's that, and you often see this in periods of recession or downturn. The first impact is on the number of transactions. What determines how far prices slide is usually related in some way to employment or unemployment. So at the moment, well, we might not be seeing much impact in prices, but transactions are off a cliff. So and that's definitely happening in the UK, and it's happening here too as well now.
Pete, you're going to have to fill me in on this one because I don't follow it that closely. But when it comes to auction clearance rates, are those? I'm guessing that's a pretty poor metric to be using right now because we're not having too many auctions, or is that off the mark?
Yeah, that's it. There's very few, and it's just a logistical thing now. I mean, for sure, you can have online or virtual auctions, which in other parts of the world they've been popular for years, but in Australia, it's very much been about the getting people on site, creating an atmosphere and a bit of FOMO and stuff like that. But that's just not happening now, just from a logistical standpoint. So the number of auctions is so small, the pool is so small that it's just statistically not relevant at the moment. So I guess all you can do, and I would encourage anyone who's interested in property to do this anyway. There's always a lot of vested interests, pushing certain angles or trying to be the guy who called it and did this, that, and the other. But most of, it doesn't really make a whole lot of difference. Prices are down 20% in Gympie, but you live in North Melbourne. I mean, what does it mean? You've got to look at your local market, where you're interested in buying, and speak to some agent, try to get a feel for what's selling at what price, even if it's off market. Because the statistics can mask a lot of different underlying trends.
Absolutely. How about, I guess one thing that you kind of touch on there is the difference between city and regional areas. If we could probably cut and slice the data in any number of ways, but are we seeing anything insofar as more expensive properties? You mentioned that 2 mil limit there. Are we seeing anything with regional versus CBD? Anything out of the ordinary there so far?
Yeah, areas where there is a high reliance on tourism, I would say, typically Gold Coast is one of those areas because it's not just overseas tourism. As you know, people fly up from New South Wales to Gold Coast for rentals, and that's not really happening at the moment. I imagine Cairns, similar story. So, I think probably some areas are getting hit harder than others, especially if there's a reliance on short stays, holiday makers, tourism, that kind of thing. International students as well. I think, I don't do anything in that sector, but I imagine there's a bit of pain playing out because half of the international students haven't been able to return. So, there's a bit going on in different sectors, but it's a very fluid situation at the moment. It's not like we can refer back to precedents and say, well, this is what happened last time. As we speak today, Australia seems to be better placed than almost anybody in the world from a coronavirus perspective. But obviously, when you're talking about global pandemics, it pays to be a little bit wary about making predictions.
Speaking of, I might rather than actually make a prediction, I might actually ask you to instead of a prediction on prices, maybe a prediction in terms of the horizon that investors can probably think about. We've got this 6 month. I've someone that I know calls it a bank holiday, or a loan holiday, effectively, because you don't have to pay interest on your mortgage, and a lot of people are getting subsidised. And the concern amongst some investors is that, what happens in 6 months. You talked about how some rentals are bouncing, but the question is, how long do we kind of sit in this? Is it going to be a U-shaped recovery, a V-shaped recovery? Who knows? What's it going to be? If
I knew the answer to that, I would, that would be great. I mean, I guess, maybe none of those. Maybe it would be like a square root-shaped recovery. I don't know that it would be very easy for developed economies to go back to the level of output they were at very quickly, simply because, modern economies are not designed to be shut down like that. So, I think, different people have different views on this, but it's very difficult for a lot of businesses to go back just to simply reopen. I'm thinking, cafes, restaurants, consumer-based businesses, can they just go back to how things were just by switching on flicking a switch? I'm not so sure about that. So, but in saying that, I mean, the time of speaking, I think Australia's rattled through about 15,000 tests today, and we've come up with essentially nothing in New South Wales, Queensland 0. A lot of the states and territories are seeing 0 cases. So I'm sure the clamour for reopening will begin now. But obviously that we haven't even seen, earnings seasons roll through yet. What happens to unemployment figures? The real unemployment figures, underemployment. There's a lot to play out yet before we can say we're back towards some kind of normality.
Yeah. So this is an interesting one again, because when people talk to us about investing in the share market, just allocating capital to risk on assets, we say, if you're talking to a direct investor, the reply is kind of like, the best time to be an investor is today. You could have been an investor 20 years ago. That's probably a better time, but just get in the market now. I guess when it comes to property, what's the advice that you would have for someone? If you had a client that comes to you and they say, is now a good time to buy? What would be, I guess, even just a generic response to that?
Well, look, it comes down to personal circumstances and goals. I mean, so I have a mortgage pre-approval myself at the moment, but I'm still trying to find something appropriate to buy at the right price. I think a fair few buyers have got pre-approval and they're just sitting on their hands until they're clear that there's light at the end of the tunnel. But I guess we try to think of, when we're thinking of wealth building, in 3 different time frames. And generally speaking, for sure you can do flips and renovations, but most people who invest in property, so it's a wealth 3 or a bucket 3 type asset. So it's kind of long term and legacy, and it's a bit like your superannuation, or those the big systemic companies you just throw in the bottom drawer and they just pump out the income. So I mean, if you're looking at a 20 or 30 year investment, then this is one of the great real estate mantras, wasn't it? It's always never a better time to buy, or the Buffett quote about someone sitting in the shade today. But generally speaking, you shouldn't really judge a 20 or 30 year investment on what's happening in year 1, and there may be an opportunity in 2020 to buy when there is less competition. But I guess what a lot of people are doing at the moment is they're just making sure that things are sort of improving again and they're not overpaying, because I guess that's one of the cardinal sins when you come to invest.
Yeah, absolutely. One of the data points that you brought up in a recent blog post, which for me suggested, if we're thinking in terms of probability, it suggested perhaps a slightly more drawn out impact from coronavirus on the housing market. And that was the data point you brought up about new housing starts and how they could drop pretty far. Perhaps you can shed some light on that.
Yeah, well, I mean, it's approvals were dropping anyway, but now, I mean, it's a very difficult prospect to get a new development off the ground. Financing is slow to come by. There's a lot of uncertainty, and just generally speaking, people, they don't like to buy new property off the plan if there's uncertainty about where prices will be in a year or 2 from now. So I suspect, UBS thinks the lowest housing starts since at least 1960. Some other stats show, well, possibly lowest housing starts is 1950. So that, I mean, that's going to the new dwelling supply is going to dry up, I suspect. I mean, that in itself is not bullish for the economy, because in Australia, almost 10% of the employed labour force works directly or otherwise in construction, and about something like 3/4 of that at the peak was in residential. So, if that sector is grinding to a halt, there's potentially 600,000 or 700,000 jobs there on the line, and and for sure the government can kick off infrastructure projects, but they'll need to be pretty labour intensive to plug a hole like that.
Yeah, it's one of those things where I guess you look at the construction sector at the moment and things are kind of ticking along. I've heard of Bunnings warehouses selling out of just about everything, because people are trying to do things on their house, or tradies are getting into stock up because they're worried about supply. But then I guess that's kind of that second order impact is, what happens in 3 months? What happens in 6 months? And I guess credit is a big concern there too. Pete, is there anything else that you in particular are seeing in the data now, or that you're waiting to see?
Yeah, not really. I mean, so a lot of the official figures, they lag massively. So, and that's why auction clearance rates that you mentioned, even if it is a small sample, people are typically like to watch them because it's a real time indicator, however transparent those figures are. So yeah, mostly I'm just speaking to mortgage brokers. That's usually one of the best lead indicators. If people are picking up the phones to their brokers and saying, right, I want to get a mortgage and I'm interested in buying, that tends to give you the best picture of where things are heading over a few months. I mean, what we're seeing is, there's a lot of people interested in buying. In fact, if you go back to what Cameron Cusher at REA Group is doing, I mean, he's saying the year-on-year searches now, well, they basically crashed in through March, but through April now they've bounced to be, well, I mean, they're 37% higher year-on-year. Now, for sure, there might be some people just browsing, but it's I think it's an indication that perhaps, as you mentioned, low interest rate environment, people don't know what else to do with their money. There may well come a point where, when we come out the other side, there could be quite a flurry of activity. But at the moment, not seeing that.
Yeah, I guess those types of stats around usage and those digital analytics are quite peculiar right now, because what we're seeing on the stock market side of things and with our publishing business and like even with our podcasts and our videos is what we're seeing is this massive increase in traffic, a lot of inbound interest, and it's coming from two particular groups. It's coming from those who are, just outright fearful about what's going on and are seeking any type of information that can shed light on what's going on in their portfolios. But then on the other side, you have those who are seeing this as a real opportunity. So you kind of have that greed figure, like, what are the signals I need to know? And to translate into property speak, it might be, are there any fire sale houses in my area? Are there off-market transactions? What do I need to know to make a good decision right now? So I guess you could take those types of stats one way or the other.
Yeah, and more people working from home, probably a bit of time on their hands. That itself could drive online traffic. But it's I mean, if you look at the bounce in the last 2 or 3 weeks, it's quite pronounced. So maybe there's a sense that, well, maybe Australia is going to reopen for business. And one of the things we did find back during the election, that when the election result happened, we ended up with this what they call it, like a cobweb effect. That's an economic term, but essentially there was no stock because nobody had listed properties during the election campaign because, well, there were a few buyers around. Everybody was very cagey. When the market bounced 26th, 27th of May or whenever it was, and then APRA released a few, just eased a few of its regulatory policies, and then suddenly there was this massive surge of buyers. And there was just nothing to buy. Certainly no quality stock, and that, I guess, what we may find is a dearth of quality new listings. I think if you look at the stats at the moment, they're probably off. New listings are down by close to 40% from where they were. At one stage, they were down almost in half. So there's probably plenty of age listings on the market, but new listings are pretty low at the moment. So I guess it just depends. Can the government switch the confidence back on quickly? If it can, then we might look back and this is just a blip for the housing market rather than anything else. But if it drags on for months, then different story.
Yeah, I think there's one thing that I get from reading your blogs and your updates is that there are so many indicators, and some of them, like you said, are better than others. And I guess you need to make an inference into the data to understand, what variables are important to where you're buying and what you're looking for, as well as obviously the asset. Like you speak of quality assets quite a bit, buying and holding, thinking of these assets as a legacy asset. They're definitely not a trading asset. Pete, I think, this would be a really good chat to have again, maybe in a few months once the dust settles and we have a bit more of this data. But in the meantime, your book's going to drop, so I'm keen to give that a plug. I'll be picking up a copy. You said, is that coming out in a month?
Yeah, so it was actually due to be out already, but it's went to China for printing, so a few delays on that side of things. But you can pre-order it from Dymocks already. Low Rates, High Returns is the book. There is a free chapter there if you want to get a download. So it's www.lowrateshhighreturns.com/book, and there's some blog content there as well, actually. So I'll give you a flavour at lowrateshhighreturns.com.
Yeah, great. And I'll pop it in the show notes, as well as I'll provide a link to your Twitter if anyone wants to reach out and get in contact with you. But Pete, mate, it's always a pleasure to have you on here, Perspective. So thanks again for joining me, mate.
Yeah, pleasure. But warning to Twitter followers. I block early and often.
Good one, mate. All right. Thanks.
Cheers, Owen. Great to speak. Speak soon. Cheers.
Cheers.